everyone, a very good evening to everyone. I hope you all are fine and doing well. So in today's class, we are going to start our Module A, Unit 1, Exchange Rates and Forex Business. So kindly watch the video, ask your doubts in the comment section and also give the answers of the questions whatever I asked in the last of this session. So let's start with the class. I hope that I am audible. My screen is visible. Everything is okay. So let's start with the class. Exchange rates and forex business. The two most important terms are there in this chapter, in this chapter's name. First one is exchange rate. Can you tell me that what is the meaning of this exchange rate? That what is exchange rate? See, if we say the definition of exchange rate in easy way, that exchange rate means what is the rate of one currency in comparison to another, right? And what is this forex business? Forex, FX and foreign exchange business. These terms are same, right? So what is the meaning of this forex business? Forex business, we can say that this is basically foreign exchange market in the global decentralized marketplace for exchanging the national currencies. As you can see, the last cycle, December cycle, BFM questions are quite difficult. Yeah, right? Moderate to difficult. If you have the concept clarity, easily you can clear the exam. But for this, you don't have to read the things only. You have to practice, you have to revision on daily basis. So, we will revise every unit with the help of MCQs, PYQs and everything. And we will learn everything in the deepest manner. Right? So, the forex business or foreign exchange market is the global decentralized marketplace for exchanging the national currencies. And it is the world's largest and most liquid financial market, right? And you can say that here participants range from large banks and corporations to individual retail traders. They are engaging in the currency conversion for practical reasons to speculate on price movements for the profit, right? So what is the meaning of this foreign exchange? Means exchange of one currency into another's country currency, that is called the foreign exchange, right? So like rupees 83 is equals to 1 US dollar, right? 1 US dollar is equals to rupees 83. So whenever an Indian importer buys the dollars to pay the US supplier, it is a foreign exchange transaction. That is called forex exchange transaction, or you can say that this is also, you can say FX. This is the shortest name of foreign exchange market. So foreign exchange of one currency, one country currencies into another country's currency. Foreign exchange market. This is the market where foreign currencies are bought and sold. This is the market where foreign currencies are bought and sold. It is a 24-hour market. It works across in different time zones in Asia, Europe, USA, Dubai. Over the counter market, no physical exchange is there like stock market. Operates through banks, financial institutions, dealers and brokers. So US dollar INR trading in Mumbai, Euro US dollar trading in London, Japanese yen US dollar trading in Tokyo. So one market closes, another opens. That is the foreign exchange market. And it is 24 into 5 days market. Saturday, Sunday is off here, right? Then what is the importance of this forex market? Why this is one of the sector which is growing too much? What is the importance of this forex market? See, in importance, we can say that first thing, that is 24 into 7 market, highly liquid, and here you can say that any type of buyer available, right? And forex market plays very important role in the international trade, right? In the international trade, it imports, here the importers obviously they need foreign currency, right? Importers need foreign currency. Also exporters here receives the foreign currency. And here are the flow of funds is quite good. Foreign investments are there. Remittances are there. And apart from this, you can say external borrowing are there. Economic growth is there. It supports the globalization. And it also facilitates international payments. That's why this foreign market is very important, right? So I hope that this is clear. What is exchange rate, what is forex business, and what is the meaning of this, what is the importance of forex market. Now Indian foreign exchange market, let's learn about Indian foreign exchange market. Indian forex market has developed strongly. Why? Just because of three things. First is liberalization, globalization, and also privatization. Privatization, here first if I tell you about the liberalization, because three terms, these three terms are very common, but we have to know the meaning of liberalization is the process of reducing or eliminating government regulations and restrictions on the economic activities. It allows greater private sector and foreign participation. It includes like deregulation of industries, it easing of trade and investment policies, and the globalization. Globalization is very important. Why? Because in globalization it is the it increases the interconnectedness of economies, cultures, societies which are at the worldwide level, driven by trade, technology, and the flow of information, right? And what is the meaning of privatization? Privatization, you can say that is the concept, is the process of transferring the ownership, control, or management of a public sector entity to the private sector, essentially shifting from government hands to the private hands. Obviously it will leads to increase efficiency and reduce government burden and also introduce market forces, right? So that is three things. So what are the key points here? It is completely regulated by the RBI. Bank are act as authorized dealers here, and market practices, these are aligned with the global standards, right? So that's why Indian forex market is strongly developed. So dealing room operations, what is dealing room operations? This is the heart of the bank's forex operations. Heart of the bank's forex operation. Why? Because it is also called profit center of the bank. Why? Buying and selling foreign currency is happen here. It helps in managing the risk. It also quotes the exchange rates. It ensures that everything is according to the RBI and FEDI rules. And why the control is important? Why that control is important here? Because large volume is available here, high risk is available, 24 hours operation is available. So with the help of proper management, control and the guidelines, it ensures obviously a good and entire order type of market. That's why control is necessary. And we know that if we managing something at a big level, we need control, right? So first here, exchange rate, whatever the price of one currency in terms of another currency, that is called the exchange rate. Price of one currency in terms of another currency. Like example, US dollar INR is equals to 83.20. That means 1 US dollar is equals to 83.20. This is very simple arithmetic expression of the value, right? Value date, when the actual settlement happens after the deal. That is the date, actual real date when the settlement happen. So basically we have different types of deal. In cash deal, which is called immediate basis, like everything happens on the same day. Term, next working day, means the deal is done today and the settlement happens tomorrow, if there is no holiday available, right? Then we have spot, 2 working days, means if deal is happening today, then the settlement will happen after the 2 days, after the 2 business days, right? So that is called spot. So if trade date is Monday, so in spot value date is Wednesday. That is called the value date, right? Now we have authorized persons. What is the meaning of these authorized persons? Authorized persons, these are the entities who got permission by the RBI to deal in the foreign exchange. They deal in foreign exchange. They got the license from the RBI to deal in the foreign exchange. So it includes what? It includes authorized dealer banks and money changers, as well as financial institutions. Right? You cannot buy directly US dollar from RBI. You have to buy it from the authorized dealer. Right? Then we have OTC market. What is the OTC market? That is over the counter. Over the counter means forex market is an OTC market completely, because there is no centralized exchange available. Transactions happen directly between the parties. Deal done through the phone electronic system. So you can say that if a bank is in the India, it directly deals with the bank in London, just because this market is completely the over the counter, right? Cross rate. What is the meaning of cross rate? Very important questions are there. Cross rate is the exchange rate of two currencies which are not directly quoted, because that is not available. But with the help of cross rate, it is useful calculated using a third currency. Example, if suppose US dollar INR is 83 given, Euro US dollar is 1.10. You have to find Euro INR and it is not available. But with the cross rate mechanism, with the help of cross rate mechanism, you can find Euro INR. How? That 1.10 is multiplied by this 83, you got 91.30. So Euro INR is equals to rupees 91.30. That is the cross rate. And so many numericals are there on this cross rate. You must know how to find the third currency if the direct quote is not available. And the most important, FEDAI, which is a self-regulatory organization, and it is established in 1958. What is the full form of FEDAI? Foreign Exchange Dealers Association of India. Foreign Exchange Dealer Association of India. It sets market practices, it provides guidelines, it standardizes forex operations in the India, right? So lots of things are done by this FEDAI. And one more thing, example, you can say it, they basically give the rules for the forward contracts, for cancellation, for delivery procedures. So FEDAI is one of the most important organization which provide guidelines how to deal, how to do the things in the foreign exchange market, right? Now we have here FEDAI. Then we will learn about the forward contract. What is the meaning of forward contract? It is a binding agreement. Binding agreement to buy or sell a foreign currency at a fixed rate. Right? Example, suppose if any importer is there who books US dollar 1 lakh at 83 rupees 5.50 for 3 months. Now, even the rate becomes 85. Bank have to sell it only at 83.50. That is called the forward contract. Suppose if two persons who are worrying about the future rates, so what they will do a contract, buyer and seller, they will do a contract today on today's rate, and the settlement happens after 30 days or whatever the contract is saying. And after 30 days or after the time whatever is mentioned in the contract, they have to do the settlement according to the price they fixed earlier. That is the concept of forward contract. Is that clear? That what is forward contract? Okay. Now what is premium and discount? Premium or discount arises due to interest rate difference between the two countries. Suppose if a premium, what is premium? It is at if a currency is at premium when it commands more units of another currency in the future. Example, if two persons do a forward contract and there the spot price is 83 rupees. They do a agreement on 83 rupees. But after 3 months, that rate become 83.50. So obviously that 50.50 is the benefit for one party. So that means US dollar is premium because future prices is higher, right? And what is discount? When discount is basically currency is at discount when it commands fewer units in the future. If the rate is 83 and in future it become 82.70, so that we can say US dollar is at discount. So what we learn up till now, forex market is a 24-hour OTC market. Exchange rate, that is the price of one currency in another. Value date is the settlement date. Cross rate is the derived rate which we have to calculate. Forward contract is future purchase or sale. Premium or discount, that is interest rate differential. FEDI regulates the market practices in the India, and dealing room control is critical due to high risk, right? So in this chapter, basically daily we will revise the chapters just in a short way, because in one day we can't complete the complete chapter in just 1 hour. So we have to do the chapters, the important things, all the important terms. Apart from this, if you need any type of help, just do the comment and let me know, so I will help you, right? Okay, what is swap? It is an agreement. It is an agreement where two parties exchange specific streams of payment or their cash flows over an agreed period of time. Swap is an agreement where two parties exchange specific streams of payment over an agreed period of time. Instead of one single payment, multiple payments are exchanged over the time, right? Multiple here things are exchanged over a time. Okay, example, if bank A gives interest payment, bank B gives INR interest payment, they continue the exchange for just a fixed period. That is the meaning of swap. Or in easy words, you can just, this is a derivative product. So what is the meaning of swap? In simple words, you can just learn this is a financial contract in which two parties, they are agree to exchange the cash flows or liabilities from two different financial instruments over a specified period. And these contracts are primarily used to manage or hedge against financial risk, such as interest rate and currency fluctuations, rather than for speculation by retail investors, right? Is that clear? Now let's learn about fixed exchange rate. It is the official rate which are fixed by the monetary authorities like RBI or the central bank. If RBI declares that 1 US dollar is equals to 75 rupees, that is fixed, market participants have to follow this rate. Floating exchange rate, as the name is floating, it is decided by whatever the market forces of demand and supply. More demand for US dollar become expensive. Less demand, US dollar become cheaper. So India follows a managed floating exchange rate system, right? Then we have the most important thing is there, the direct exchange rate. Direct exchange rate. What is the meaning of direct exchange rate? See, direct exchange rate basically when the exchange rates are expressed in terms of home currency. When the exchange rate expressed in the terms of home currency. Example, if US dollar INR is equals to 83, right? That means 83 rupees for 1 US dollar. This is the example of direct exchange rate. But parallelly, what is the meaning of indirect exchange rate? Indirect exchange rate, when exchange rate expressed in the terms of foreign currency. Example, you can say if INR US dollar is equals to 0.012, that means 1 rupee is equals to 0.012 US dollar. That is the example of indirect quote for the India. Is that clear or any problem? I hope the things are clear. So if you like this session, kindly give the like, that is important, and also do the comment if any problem is there. Okay, now we will learn about ready or cash rate. It is a type of deal which is immediate basis, which happens on the immediate basis, where the transactions settled on the same day. It is called value today. Today deal, today settlement. Deal to happen today, so the settlement will be happen today. Right? Tom rate, tomorrow rate, transaction settled on the next working day. So deal on Monday, settlement happens on Tuesday. Why Tuesday? Because Saturday, Sunday is off. Right? Just wait. Here Monday, settlement on Tuesday. Suppose if settlement is done on Friday, so deal is done on Friday, then in that case Saturday, Sunday is off, so settlement will happen on Monday. And if any holiday is there, sudden holiday, then also the next business day settlement will happen. Generally the meaning of Tom deal is just the settlement will take place on the very next day. Spot rate, where the transaction settled on the second working day from the date of transaction. If deal is there on Monday, settlement will done on the Wednesday. Most of the popular deal in India and forex transaction. Forward rate, when exchange rate for the settlement beyond spot date, any day of settlement apart from the spot date. Right? In this, basically settlement happens after 1 month, 3 months, and it is usually used mainly why? Just for hedging the future risk. Right? Then we have here the thing which is foreign exchange risk. What is the meaning of foreign exchange risk? Foreign exchange risk of loss due to the adverse movement in the exchange rates when a bank opens a position in foreign currency and you know that exchange rates are fluctuates in every 4 seconds, 21,600 times a day. So foreign exchange risk is the risk due to the adverse movement in exchange rate when a bank has an open position in foreign currency. Suppose if a bank buys US dollar at 83 rupees and rate falls to 82, so obviously bank will suffer loss, right? Then what is the meaning of transaction exposure? Transaction exposure. See, when the risk arises due to the exchange rate changes between the transaction date and settlement date. When the risk arises due to exchange rate changes between the transaction date and settlement date. Example, suppose any exporter is there who invoices US dollar today, right, and receives the payment after the 3 months. So if US dollar depreciate, exporter loses the money. That is called the transaction exposure. And the same term is there, that is called translation exposure. What is the meaning of translation exposure? Risk arising when the foreign currency assets and liabilities at the end of the accounting year. Risk arising when valuing the foreign currency assets and liabilities at the end of accounting year. Means assets and liabilities mature in future, so they revaluate at the current exchange rate. Example, you can say foreign branch assets converted into the INR for the balance sheet. That is called the translation exposure. Is that clear? Okay, so that is translation exposure. Now we have operating economic exposure. Means how the future cash flows and profit are affected by the unexpected exchange rate changes. So if INR appreciate, export become expensive. Profit may fall in future. So this is a long term exposure. Open position. What is the open position? Open position is the difference between the assets on whatever we purchase the contract and the liabilities and the sale contract. The difference of these is called the open position. If a bank buys more US dollar, then it sells. That is the long position. If the bank sells more US dollar, then it buys. It is a short position. Right? So these are the important terms. When we solve numericals, this will help us. That what is the open position, long position, short position, overnight position. Obviously, maximum open positions allowed to carry forward only for a night in a major currencies, because it controls the risk and it avoids the losses due to the overnight rate changes. What is the meaning of daylight position? When the maximum open position allowed during the trading day. Basically here are the limits are higher than the overnight limits, and it must be squared off before the day end, right? These are squared off. And then we have very important one derivative, which is called options. So what is the meaning of option? When a forex option, when a forex option gives the holder the right but not the obligation, to buy or sell a currency at a fixed price on future date. When a forex option gives the holder the right but not the obligation to buy or sell a currency at a fixed price on the future date, right? And here the loss is limited but profit potential is unlimited, right? So in this we have one thing which is called call option. What is the meaning of call option? Where there is the right to buy a currency at agreed price. Where right to buy a currency at a agreed price. So importer buys call option to buy the US dollar at 83 rupees. And what is the meaning of put option? Where right to sell a currency at a agreed price, right? So example we can take, exporter buys put options to sell US dollar at rupees 83. So what we learn here up till now, first let's learn about the future. These are the standardized forward contract which are traded on exchange. These are fixed in size, maturity fixed, exchange are regulated, and settlement happens daily. And like future currency futures on the NSE. What is the meaning of currency swaps? Currency swaps. Currency swap, we can say that it is a type of financial agreement where two parties exchange principal and interest payment in the different currencies, and it often to lower the borrowing cost or hedge against exchange rate risk. And it also allows companies to access cheaper foreign capital market or manage the international debt. Basically, so you can say that agreement where two parties exchange principal and interest payment in the different currencies. If company A gives US dollar, company B gives INR. So payment exchange over the time. And what is the meaning of interest rate swap? Where the exchange of interest payment streams of the different types. Means you can say in the interest rate swaps are those financial derivatives where two parties they exchange the stream of interest payment. They swap fixed rate for a floating rate, right? Example, one party pays fixed interest, other party pays the floating interest. There is no exchange of principal. So what we learn up till now, swap where the exchange of payment streams happen, fixed rate are decided by authority, floating rate are decided by the market factors, right? And spot is T+2 settlement, means settlement happens after the 2 days. What is forward? Which is beyond the spot. Transaction exposure is for the short term, translation exposure is having the accounting impact. Operating exposure is a long-term effect. Call means right to buy. Put option means right to sell. And futures are the standardized forwards. Right? Now, the first question is there. If 1 US dollar is equals to 68.10 rupees, so what is the exchange rate for 1 US dollar? See, 1 US dollar is equals to 68.10 rupees. Right? So, this statement itself defines the exchange rate. Exchange rate is what? That tells us how much of one currency is required to obtain 1 unit of another currency. So, how many Indian rupees are needed to buy 1 US dollar? 68.10. Right? So, the correct answer is here option A, 68.10 Indian rupees. Is that clear? Now the next question, what conditions must be met for settlement in the forex market when dealing with holidays in different countries? What type of the conditions must be met for the settlement in the forex market when dealing with holidays in the different countries? Very simple. When two countries they exchange money in the forex market, the payment happen only when banks are open in both countries, right? And why these holidays matter? Because every country having their own holidays according to their culture and according to their work. If there is if any one country is on holiday, so obviously banks there are closed, and if banks are closed, that means no bank transfer, no money transfer, right? So settlement cannot happen on a holiday. If the normal settlement date falls on holiday in any one country, so the deal is settled on the next day when the both countries are working. This day is called the next common working day. So the correct answer is here. The settlement date should be the next common working day in both of the countries. Option C is correct. Clear? What does the term nostro account refer to banking? Nostro account. What does the term nostro account refer to the banking? See, very simple explanation I am giving you. What is the meaning of this nostro account? Nostro account means our account in the foreign bank. Our account in the foreign bank. How to remember? Nostro when our account is foreign bank. Vostro when the your account is there. And what is loro? When their account is. Right? So nostro account, our money kept with the foreign bank. So here the meaning of nostro is our account with a foreign bank. Option A is correct. Next question. When arbitrage involves 3 or more centers and multiple currencies, what is it referred to as? Arbitrage. What is arbitrage? Suppose in one market rates are very low. So what arbitrators do? They purchase the currencies from this lower market and sells to the another market where the rates are high. So that difference of these high and low is called the profit for the arbitrators. So when they are involved in two or more currencies, what it referred to as? Basically uses money, then one currency, more than one currency. Money is moved through three currencies. So this type of arbitrage is called compound arbitrage or 3-point arbitrage, or also you can say triangular arbitrage, right? Direct arbitrage, where only two markets and one currency pair is there. Simple arbitrage, basic form, no multi-currency is there. Indirect arbitrage, where uses the cross rates but not full 3-point arbitrage. So three currencies, 3-point arbitrage. So the answer C is correct here. Clear? Next question. In the currency pair, if US dollar INR is equals to rupees 68.1011 per US dollar, which is the buying rate and what is the selling rate? Very good question. Very basic question. So tell me the answer. Very simple. Because I think that if you are doing any thing, so you need the concepts in a very from the zero level, right? So here you can say very simple 68.10, this is the buying rate, and 68.11, this is the selling rate, right? First rate is the buying rate always, which is also called bid rate. Second rate is called selling rate, which is called ask rate. Buying rate, when the bank buys US dollar from the customer at 68.10. Selling rate, when the bank sells US dollar to the customer at 68.10. So bank always buy cheap and sell costly. So that's why buying rate is smaller than selling rate. So the correct answer is here option A. Next question. What is the buying rate in the currency exchange transaction? Very simple answer. In a currency exchange transaction, the buying rate is rate that which the bank buys foreign currency from the customer, right? The rate at which the bank buys the foreign currency. Which type of exchange rate is set by monetary authority and usually pegged to one or more currencies? A fixed exchange rate is the rate that is decided by the monetary authority like RBI, and it is pegged, means linked to one currency or a group of currencies. So government or central bank controls the rate instead of leaving it to the market. So the correct answer is fixed exchange rate. In a floating exchange rate system, how is the value of exchange rate determined? How is the value of exchange rate is determined? What is floating exchange rate? Obviously, where the value of one currency is not fixed, value of the currency is not fixed, right? And it changes constantly in the market. Central bank does not fix it. The rate is determined by how much people want to buy or sell, right? So you can say by the supply and demand factors of that particular currency, the value of exchange rate is determined. Clear? Is that clear? Now, next question. When did India switch to the floating exchange rate system? When did the India switch to the floating rate system? India used a fixed rate system before 1991, but after the economic liberalization in 1991, India gradually moved to a market determined rate. And officially by the 1993, India adopted a floating exchange rate system where the rupee value is determined by demand and supply in the market. So the correct answer is here option B. What is simple or direct arbitrage of forex? I already told you, simple means you buy a currency in one market where it is cheaper or sell it another market where it is more expensive to just earn the profit. It is called direct because it involves only one currency pair and two centers in the market, right? So buying the one currency in one center and selling it to the another center for a profit is the correct answer. What is the primary difference between a ready cash and a term rate in forex settlement? See, this first question, second question, very easy. Third question, fourth question, and this one is fifth, and this one is 5 questions. These 5 questions you have to tell me in the comment section. If you know these, all the 5 questions, you have to tell me in the comment section the answer. And this is the homework of today's class. You have to attempt these 5 questions and give me the answers in the comment section. So I will know that you already understood the chapter's basic terms, right? And if you have any type of problem, just do the comment, any issue with any concept. And if you like this session, so give the like and subscribe to the channel so we can cover so many topics in our upcoming classes. So if you have any type of problem, I am there. Just start learning and start practicing to just clear your CAIIB examination. So thank you so much. Let's meet in our next class. Till then, take care and have a good day all. Thank you.